Hello and welcome to Chapter 2 Homework Overview. That's a little bit better to say. I'm sorry about the sound quality on the mic. It's all I got to work with right now when I record this method. So, question number 1. Suppose the following items are taken from December 31st, 2017, Asset section of Boeing. Balance sheet. Now again, they really do use these numbers, so it's actually pretty cool. So all we're doing is a classified balance sheet. Okay. First off, again, this is only a partial, as it's telling you, because we don't have everything. Again, balance sheets are always specifically dated. So first thing that we have, really all it's doing is assets. That's pretty cool. Is there anything else that we have? Nope. So all we care about is the asset accounts. Yay! So first off, start with current assets. Okay. Let's just type that in. Won't let us. Okay, let's go find it. Where's our current? There it is. Current assets. Let me make this just a little bit bigger. I guess that didn't work. Okay. Back off. Let's see if I close down this side. There we go. That may make it allow us to go a little bit bigger. There we go. Not bad. Okay. So, current assets. Now remember, current assets are assets that are basically done within a year. Basically, we've either converted them to cash or they're going to be removed. So really, the easy ones is of course cash is our first one. That is 9,400. Next, and they say in the order of liquidity, so how easily converted, would probably be accounts receivable. So we'll have our accounts receivable, 5,740, and then pretty much inventory. Actually, probably debt investment will be next, because that one's actually probably going to be able to get rid of a little bit quicker. Inventory, and that was 15,950. And then finally, we have one more blank, and we have actually two note receivables. We want to do the ones that are before 31st of 2018 because they actually are within a year. So that's the note receivable that we're going to use. So note receivable due before 4/20. And then we're going to basically add them all together. So 9,400 plus 5,740 plus 1,740 plus 15,950. Oops, forgot the plus. There it is. And finally 4/20. Okay, we have 33,250. And that is, of course, our total current assets. There it is. Okay, next, we should actually have our long-term investments. There it is, long-term investments. And it'll be that note receivable one more time. Except, of course, this note receivable is after. So 4,810. Okay, I'm on. Go ahead and decrease just a little bit. Alright. Then next, this is going to be real easy because, again, I see this little colon, which basically means less our accumulated depreciation. And let's see, which one do we have? We have buildings. So if the accumulated depreciation is for buildings, we know that our property, plant, better be for buildings. So let's fill in those numbers. We have 21,250. We have accumulated depreciation of 13,270. And then all we have to do is subtract 21,250 minus 13,270. We have currently a value of 7,980 for that building. Okay. Last is, of course, your intangibles. There we go, tangible assets, which is only our patents. And they are 11,760. And of course, we find our total assets. And that's going to be the total of all of these. So 33,250 plus 7,980 plus 4,810 and then 11,760. So 57,800. Okay. So if you ever have a trouble, again, you can click on ebook and media. You can actually click on the ebook and it should go to the book. You may have to register for the book. Well, this is just in case you just need help with ordering. Like here, I got the liquidity just a little bit off. I can still verify that's that way, but you may want to actually do it exactly how the book is. So let's go ahead and we'll move up the debt investment. And we'll put the account receivable right here. And that was the 5,740. And then they want, according to the book, note receivable somehow beats out inventory. Wow. Okay. So this is inventory. So sometimes you do have to look at the book just to see how the order that Wiley wants it in liquidity. The way I had it was still pretty much good. Because one, this is a complete note. So again, hard to convert. But they went ahead and go with it. So let's submit. Let's see how well it was. And there we go. That's really it for question number 1. Again, they will show you can also do a negative right there. But either way, it's perfectly fine. Alright, question number 2. Alright, so these items are taken from the financial statements of Bonita Industries. And again, they want us to do a classified balance sheet, but the complete classified balance sheet. Ooh, okay. So first off, always remember your date, always specific. First things that we hit is the current assets. There it is. Cash is number 1. This time we only have 3. So we know we have cash, accounts receivable, and prepaid insurance. Well, if you want to reference back to the book, we saw that prepaid was at the end. So we're okay with that. So cash was $11,130. Accounts receivable was $11,844. Prepaid was $3,008. Okay. And again, we'll have our total current assets right there. Add these up. And remember, again, your numbers may be different than mine, but the process is still the same. 11844. And 3008. 25,982. Okay, so there's our current. Next, we've got land. We actually have our property, plant, and equipment. Because again, we're seeing these less. Let me scroll down so I can get back over. There we go. So we have 2 property, plant, equipments that are being depreciated. And then we get land. Okay. Now the reason why I can tell the difference is because again, land does not depreciate. So we shouldn't have accumulated depreciation for land, while the other 2 will. So first off, land is $57,528. Okay. Let's find the first one. We have buildings. So buildings in themselves. Where are you? There it is. It's at the top. Duh. Buildings. Okay. Whopping total of $99,452. Less its accumulated depreciation. And we have $42,864. Okay, let's go ahead and put the rest in. So we have equipment. Looks like. There we go. And equipment was $77,456. And accumulated depreciation was $17,597. Okay, now again, all we have to do is subtract these 2. So subtract the buildings from its accumulated depreciation, and we'll get the total for that building of what the value is, the book value, and the same thing for equipment. So calculate 99452 minus 42,864 equals 56,588. Okay, next, equipment 77456 minus 17,597, 59,859. Make sure I get 59,859. Alright. Actually, that's not total. I almost did a boo-boo right there. That's total assets. They went ahead and did the total right here, and they throw off with that. I went a little bit too fast right there. Because here's our total right here for total property, plant, and equipment. So let's take 56,588 plus 59,859, and then add our land, which was 57,528. So we have a total of 173,975. Okay. Next, we just add our assets together. So we only have two. So 173,975 plus 25,982. We're at 199,957. Okay. So there's our total assets. We know now liabilities and stockholders' equity must equal out to it. So let's start knocking these out. First off, of course, just like assets, we start out with current liabilities, or what will basically be paid off within a year. Again, we have 3 blanks. I like how they already tell you the order of current assets and property, plant, and equipment, so I did exactly like it said. Alright, so first thing that we have is usually accounts payable. We're going to reference right here real quick. Reason why, again, I want to do exactly in the order that they have it. Doesn't have to be, but I'm just going to go ahead and do it. Usually we have accounts payable first, but they're showing notes payable, so let's go ahead and knock out that one first. Okay, so for this problem, the thing is, we do have notes payable, and it already tells us right here, see right before the red? Assume that $12,784 of the notes payable will be paid in 2018. So that is my current number. Okay. And we'll have accounts payable, which is $8,930. And then we'll have interest payable. Should be next. There it is, interest payable. Okay, and interest payable was $3,384. Okay, again, we have to write the current amount that's basically going to be due within the year so we can better set our current assets to offset these, just to make sure we can pay our bills. So let's go ahead and get our total current liabilities. $12,784 plus 8,930 plus 3,384. Okay, 25,098. Okay. So next will be our long-term liabilities. So find those. Long-term. For some reason they actually do have a total long-term. So total long-term. Alright. So long-term liabilities is of course the note. It's the remainder of the note. So the total was 87,984. So but we're going to subtract out the current amount, 12,784. So right now, the amount that we still have to pay after 2018 is right now currently 75,200. Again, that's a long-term item. This isn't total long-term liabilities. What am I thinking there? That's total liabilities. I'm thinking more of what I would see in the real world, but really it's just total liabilities because we're just adding these two. So 75,200 plus 25,098. We have 102.98. Okay. Next, we do our stockholders' equity. Okay. And of course, first is always common stock, and then retained earnings. And then it should be our total stockholders' equity. Okay, so let's go find common stock. 56,400. Okay, and then retained earnings. Whoa, retained earnings is right here, and it really tells you that it's the beginning of the year. It's not the ending. So we can actually go and calculate retained earnings, but I'm going to show you a nifty little trick. Okay. First off, we've already calculated our total assets, and knowing how balance sheets work, our liabilities and equity must equal the same number. Okay. So right now we have our total liabilities, we have common stock. We know if we add those together, that would equal out to, supposed to be our total liabilities plus equity, but we're missing a number. So we can actually go and do this, and this is a little bit quicker. So take this, 19957, that's minus out 100,298, and minus 56,400. So retained earnings is actually 43,259. Okay. Then all we do is add those two together. $99,659. Now that's the quick way. If you want to actually take the time, you can go right here, and first thing that you would have to do is find net income. So I'm going to show you that you can do it both ways. So first off, we don't see any dividends. Don't see any dividends at all right here, so that's cool. So all we have to do is take our revenue, which is only this one. So service revenue, so 13,818. We go and subtract out all of our expenses, which we only have these three: insurance, depreciation, interest. So 733 minus 4982. Subtract out 244,402. Okay, minus those. So that is our net income. And we know with our net income, we must add that to our beginning balance of retained earnings. Again, I do not see any depreciation, so 37,600, and boom, look, exactly the same number from those two. Okay, either way is a perfectly good method. So you need to figure out retained earnings that way by doing what we've been doing, net income, adding to our beginning retained earnings balance. Since there's no dividends, you don't have to subtract those. Or you can just find the difference or find the number, the missing number. Either way is perfectly fine. Okay, we'll go ahead and submit. Make sure there's nothing wrong. And it looks like everything is perfectly fine. Again, they like the negatives. And our answer is complete. Okay, that's just number 2. Let's head to number 3, see what number 3 has in store for us. So, we have a comparable financial statement data for Bridge Corp and Sarasota Corp. 2 competitors appear below. All balance sheet data is as recorded. Cool. So first off, we have to figure out our net income, net earnings per share. Doing 2 decimal places, working capital, current ratios, debit to asset, and free cash flow. Nice. Lots of fun stuff there. Okay, so first off, we're going to figure out net income. So we have net sales, 2,340,000. Now let's see. Yeah, they just want us to go ahead and go that way. So 2,340. Okay. Then subtract our expenses, which is all right here. Okay, they try to keep it in order for us. Nice. So, cost of goods sold was 1,527,500. Subtract out, minus operating expenses of 367,900. Okay. Then minus 11,700. And then finally 110,500. So we should have 322,400. Okay, there's our net income. Okay, so do the same for Sarasota. So 806 minus their cost of goods, 442. Okay, minus 127,400. And 4,940. I actually kind of like this problem. It's actually doing a comparative, which is pretty good. 46,800. Okay, 184,860. Sure, I put that. Yep. Okay. Now remember, earnings per share. Earnings per share is our net income minus preferred dividends, which we do not have any preferred dividends, as I can see, divided by the average number of shares outstanding. Here, they went ahead and gave us this, so we don't have to worry. So really, all we have to do is take the net income and divide it by numbers of shares of outstanding. So 322,400 Divide by 80,000. $4.03. Okay. Then we have 184,860. Divide by 50,000. Sometimes that's the one bad thing about this calculator. So this is 3.697, but we rounded, so it's like 3.7. But again, they want 2 decimal place, round each one. So always follow what it states on the rounding. So right now we can see earnings per share. Bridgeport is doing better than Sarasota. Okay. Let's see how well they're doing on the others. Working capital. Okay. Remember, working capital is again our current assets minus our current liabilities. So we'll have 434,600 minus current liabilities of 86,223. So 348,377. Alright. And current ratio is, of course, our current assets divided by our current liabilities. Oh, that one I want to look back up because somehow I always switch those. So, again, ebook. We're going to go check real quick. I just want to make sure because every now and then I do flip them by accident. So, nice little ebook. And, yep, current assets divided by current liabilities. Doesn't hurt to always go look. So we're going to go ahead and do that. So 434,600 divided by 86,223. 5.0. And there's 1 decimal place. Okay, so that'd be 5.0. So basically 5 to 1. Okay. And I'm going to just put 5.0 just to be safe. Okay, so working capital again. Take our current assets minus our current liabilities, 195,436 minus 43,831 equals to 151,605. And then, of course, we just divide the two. Okay, ends up being 4.5. They're actually really close to each other right there. Okay, not too bad. Now it's time for debt to asset ratio. Alright, so we know again we have a division right here. Let's just go ahead and check the formula one last time. So, debt to asset ratio is our total liabilities divided by total assets. So when we look at this, we look up here, they don't give us our total assets, our total liabilities. We have to actually add these together. The cool thing is that they keep it in order. So all it is taking 434,600 plus 691,600. So our total assets are about 1,126,200. Total liabilities 86,223 plus 141,050. There we go. And again, all we do is take our total liabilities, divide by our total assets, and always double check your formulas. Total liabilities divided by total assets. So 227273 divided by 1,126,200. Boom. They're going to ask us, let's see how they want. Okay. Round debits to assets to one decimal place, e.g. 78.9%. And then enter negative amounts, either as negative or parentheses. Okay. So that's going to be 20.2%. Okay, there it is for Bridgeport. We'll go ahead and do Sarasota because they're different. They don't rely on the same numbers to do free cash flow and that one. So again, current assets 195,436 plus 181,646. Then you have their current liabilities 43,831, 52,889 for long term. Okay, 9620 total liabilities divided by total assets. They have 25.6. Ooh, Bridgeport's basically beating them out on all fronts. Okay, now we can do free cash flow, which is just taking our net cash provided by operating activities and subtracting capital expenditures and dividends. So 179,400 minus 117, and finally taking out 46,800. So that's 15,600 for Bridgeport. And then Sarasota, it is 46,800. That's funny that they both have 46,800 in both category. 26,000. And then 19,500. So they really only have 1,300 in free cash flows. Ooh. Not the best. Okay. So let's check. Let's make sure we did all our math correct. Yeah, everything's good. All formulas done. Way to go. Hopefully this helps. Again, if you get stuck, just send me a question. Question number 4. Let's see. So again, we're doing the formulas. So let's see here. So the following financial statements of Colorado Industry. Additional information, net cash provided by operating activities, cash used for capital, and the cash. So they give you the free cash flow right here, and they give you the weighted average. So they give you the average of number of shares, so you don't have to compute it. So compute the following values, ratios for 2017, and they provide the 2016 comparative. Alright, So again, all we're doing is the same formulas. They just have it in a different format. At least it's easier than the last one. I'm being honest because right here, you don't have to add up total assets. There it is. There's total liability. Do not worry about total equity. And it's already got your current assets. There's our current asset number. There's our current liabilities. Up here, there's our net income already calculated for you. So this one's a whole lot easier than the previous one. So this one I think y'all can handle since we already went over the formulas and how to do them. Let's see. The only thing... Let's see. Yeah, because there is no preferred dividend. So we're pretty much fine. Yeah. So don't have to worry about the preferred dividend. So earnings per share, again, is just your net income divided by total shares. Right here, 50,000. You'll be good there. So earnings per share is good. Working capital, again, current assets minus current liabilities. Current ratio, we divide the two. Your free cash flow is all in this little paragraph. And debt to assets is actually already there too. We just do our total liabilities divided by our total assets. So everything's there. Okay, cool. So let's move on to question number 5. Let's see if this is a little bit different than the previous, if it loads. Okay, so we're dealing with another financial statement. And prepare income statement. Okay, so we did the income statement in last chapter. I'm just seeing if there's anything really different. And if it's, okay, there we go. I didn't scroll all the way down. So again, all this is really is a summary of the first 2 chapters. So again, income statement, revenue minus expense. So we of course have our revenue and our expenses. So there we go, net income. And then of course right here, you take your beginning, which is retained earnings July 31st. You're going to add or subtract your net income less dividends. Now the thing that they have going on with this retained earnings statement is basically right now you total these two up, and that will become the number right there. And then, oh, wrong one. Should be retained earnings August. What the? Okay, something's off there. Let me see what's going on there. So we have the retained beginnings earnings. These financial statement items are for Sheridan Company at end of July 31st, 2017. Okay. So this one's August 1st, 2016. This is July 31st, 2017. To give you the full year. Their year is pretty much off. It's a different fiscal year. Okay, so nothing bad there. That current year in July 31st. So this is for the year ended. Okay, balance sheet. Remember, first things first is always your current assets. Okay. Then, of course, we have our property, plant, and equipment. And we always less our accumulated depreciation. This is our total assets. Okay. And then, of course, current liabilities. total liabilities, long-term liabilities. Okay. Total liabilities, and stockholders' equity, which is somewhere, there it is. This is total, and then there we go. Okay. Again, that's just some helpful hints of how to place. The only thing is, I'm not going to fill out every account because I think y'all can handle these. I really think there's not very many. Remember, revenue, expense, retained earnings. The only other item that you have to do is the current ratio and the debt to asset ratio. So these two are coming from the balance sheet. So remember, current assets divided by current liabilities for your current ratio, and then total liabilities divided by total assets for debt to asset. Okay, that's not bad. Okay, so I think that's it. Yep, that's it for chapter 2. The only reason why I'm not going over this last question is because this is basically an overview of the last 2 chapters. So you should be able to handle this one. Again, if you do have questions, make sure you ask them and we can move forward. Okay, so I will see you for the next time.